Calling the Subcommittee on Investments to order. I think, welcome. First item of business is approval of the minutes.
Move it.
Any second?
So moved.
Any comments, changes, or amendments? There being none, all in favor say aye.
Aye.
Okay. Now, all of the items today, well, we do have one item to vote on eventually, but they're all information items. Janet?
Okay. The first information item is the new Endowment Council. As you know, we established the Endowment Council as a forum for our foundations to discuss and disseminate best practices in investments and investment management, which we think is particularly timely given the increasing complexity of the global investment markets, as well as increasing regulations that especially in New York with MIFA. So our first meeting was October the 4th. We had great attendance, thanks to Matt. And we had a pretty good agenda of relevant topics. First, Cambridge Associates spoke on best practices in endowment management, and then we had two additional segments, one on a new gift agreement that the colleges and foundations could use, which is MIFA compliant, and we also spoke about the steps that one needs to take to be compliant with MIFA by the deadline of July 1st, 2012. The meetings are quarterly, and our next meeting will be November 16th. So that is the Endowment Council. The next item on the agenda is a recommendation to amend the investment policy, and it's simply to make the administration of the spending for non-endowed accounts a little bit easier. So it's nothing really substantive, but it's more for ease of administration. Our policy, as you know, is that our pool is a long-term pool. Therefore, in terms of spending, it doesn't distinguish between the endowed and the non-endowed funds. However, we do have participants with varying needs, and the policy does permit the Senior Vice Chancellor for Budget, Finance, and Fiscal Policy to authorize spending in excess of the 5% rate under special circumstances. And what the amendment does before you today is it would permit the Senior Vice Chancellor to delegate that decision-making to the Associate Vice Chancellor and University Controller, just for ease of administration. So with that.
There's a motion on the, I will move the
Second
motion that we approve this amendment. Given. Any questions, comments, changes? All in favor?
Aye.
Any opposed? None? Motion carries.
Just a quick question on,
Yes.
Unfortunately, I reread
The entire amendment, the entire policy.
and it scares me. And in particular,
Smoking?
I call your attention to the one that says subsequent monitoring of delegated areas, including reasonable efforts to verify accuracy of information provided by the agents. We can delegate, the committee can delegate, but it looks like we have some responsibility to verify information provided by the agents. I am lost as to how we could possibly do that.
What page do you want? I think
I'm
it might
on,
be
I'm
important
on,
to-
I'm sorry, it's 3C, little c.
3C.
One that's subsequent monitoring of the delegated areas?
Yeah.
That's already been approved. That hasn't been.
I don't know what reasonable efforts to verify the accuracy of the data means, because we rely on the reporting that we get. So if we can rely on that, I guess that's okay. Otherwise, it strikes me that there's a potential issue for us.
Professor Martell, if you could probably spend time with Janet and try to, decipher the language and make sure that we follow
That's
as
fine.
well as with Barry, that way,
My only issue is to make sure we're not
doing something that we can't.
agreeing to do something we have no earthly way of executing on.
Great. Okay.
Okay, great.
Performance update?
Yeah.
Yes. Thomas,
Uh,
welcome.
Thank you. If you will turn to, we'll give a slight brief update on the market just to set things in perspective. If you will turn to this page, I don't know how you do that on the,
Page 2?
page 2, yeah. Okay. As you can see, and it shouldn't come as any surprise to the committee that there was obviously a brutal quarter here. Everything except for bonds went down. Equities, the riskier, the worse, if you will. So small caps more than large caps, emerging markets more than regular U.S. equities, non-U.S. equities, and there was a currency component to it too. So that also made that the non-U.S. equities went down more than regular equities. Commodities went down as well, even though they held up pretty well through August. So it was a very tough month, and the portfolios obviously reflected that. It took the year-to-date returns down in negative territory, as you can see on the bottom hand of this chart. The good news, if you will, or on a relative basis, good news is that October has been very strong. Equity markets are up around 10%, non-US a little bit less than that. Even commodities are up, and bonds are commensurately down a little bit. So what you will see in the performance has been rectified somewhat since September 30th, just to put things in perspective. The funny thing, or strange thing, if you will, is that when you look at how things were looking before going into this quarter, or the third quarter, it wasn't actually that much different than what they looked in the fall of 2010. Lots of uncertainty about European debt situation, lots of uncertainty about a slowing economy, etc. So it's a little hard to pinpoint exactly why markets took such a tumble, whereas in the year following August of 2010, because of QE2, you actually had a pretty good return for the market. So again, keeps it a little bit humble about trying to make big swings in asset allocation, etc., because it's just hard to tell. And obviously, there's still the prospect that there might be some sort of easing or further stimulus to come, in which case you could see this market turn around again, as we've seen in October. That being said, the European debt situation has obviously deteriorated since then, and that is one of the at least the short-term thing that is really weighing on the markets these days. And the prospect of a potential solution is what also has buoyed the market in October. We'll see, as you know, there's a meeting going on right now that should be coming to its conclusion on Wednesday, and we'll see what they come up with there. To the extent that there is not a solution, that could certainly depress the market once again. To the extent there is a solution, that might buoy the market further. As you know, the European situation is a work in progress. There's a lot of difficult things going on there, including the lack of a structure to do what they're doing, not completely unlike what we did in 2008, where we also did a lot of things without necessarily having the structure in place. But their problems are a little more intractable since they can't, print their own currency. So they're really trying to figure out how to do what they need to do without necessarily also the support of the individual populations that are pretty much against lots of these things that are going on. So that's a very fluid situation. We'll have to see how it comes out, and observers doubt that there will be a final solution on Wednesday. That they will come with another step, but whether it's enough to really put the thing into final conclusion is uncertain. So we'll probably see more of this thing coming along as we go along. Mm-hmm. The next page we brought mainly to talk about this recommendation that we have regarding small cap and large cap. We have not had small cap and even mid cap in the portfolio to any noticeable degree so far, at least since we fired the small cap managers back in 2009. And the reason was that the small cap area was just very overvalued compared to large cap. So large cap was a much better deal.
What
now,
page is the term?
oh, sorry, that's just the next page, page 4.
Page 4.
So, and you can see how that works out. If you take the left-hand side, you can see that the average small cap have traded at a discount, as large cap has traded at a discount to small caps. But you can see here that discount got very steep back at the end here of 2008. It's gone up a little bit recently, but then the last month has obviously taken a little bit down again. So we still think that small caps are slightly expensive versus large caps, but not nearly to the extent that they were, and so that's why the recommendation to consider including them. But since this is moving very fast, we also advocated for a little bit of flexibility in the implementation of this. On the next page, one of the good things, if you will, of the silver linings of the sharp declines we saw in this quarter is obviously that valuation generally are becoming more attractive. The European and the emerging markets, especially, those have been hit very hard. Now, it takes a special kind of stomach to go heavily into European equities at this point because there are obviously still issues out there. But emerging markets seems more attractive. They don't have the same financial issues that we have. They have other things going on, but in general their economies are better, they're growing better, and it's a little hard for us and many observers to see why they were punished as much as they were in this quarter, when on the surface of it looks like a lot of both their companies but also their economies are a little bit better than what we're seeing in the West. Part of that was the reason why we rebalanced in the quarter. We did a couple of rebalancings, taking money from bonds that were getting out of our target area, and rebalanced by buying very favorably valued emerging markets equities and equities in general. If you look on page 6, the next page, you can see that generally we are seeing, because of this quarter, we have seen a migration from the left-hand side to the right-hand side, so from overvalued to more undervalued or fairly valued, which is again a good thing. It means that there are more areas that are attractive to invest in. It doesn't mean that it's easy necessarily, but certainly it gives us hunting ground for looking at other things. And since then, we actually had a new one coming out that was published after we produced this set of materials. But emerging markets in general have been moved, all of the equities of emerging markets have been moved into the undervalued category. So those are things that we are still very constructive on. And small caps, U.S. small cap, as you can see, is overvalued, has now moved into the fairly valued category. Just to remind you of how we use this is not something we use to make big swings in the portfolio, but it does influence us when we do rebalancings and in recommendations. So this is something we take a look at. If we take a look at the portfolio and take a look where we are on asset allocation basis, page 7, which is this page, just to orient everybody, you can see that we are slightly undervalued and under target in equities. That is again because that they took such a heavy hit. We have been rebalancing, but even that hasn't really brought us up to target. So, but with the movements we've seen in October, we would expect to be more or less on target with that rebalancings. Conversely, in fixed income, we're obviously over target. We've been bringing that down, and the movements in October have taken it further down. It looks like we're under target in U.S. equities and over non-U.S. This is slightly misleading because we are counting IVA, our global manager, as part of international, just in classification-wise, but obviously they have quite a lot of U.S. equity as well. So it would be much more in line with the targets than what we're showing here. If we take a look at the actual performance, I'm turning to page 11, the one called Flash Investment Returns by Composite. You can see that the quarter ended up with a negative 9.9 return. This is not completely unexpected, given that markets were down, equity markets were down somewhere between 14% and 20%. It is slightly better than what we've seen so far from peers. And in general, your equity managers were obviously the biggest absolute contributors to this negative return. As you can see, they were down somewhere between 14% and 20%. Hedge funds held up somewhat better, but actually were a bigger disappointment in relative terms. Real assets also underperformed, and I can go into that. Whereas the fixed income actually held up quite well, despite the fact that Colchester, your international bond or global bond manager had a little bit troublesome September. They actually held up reasonably well for the quarter. If we take a look at next page with the individual managers, Vanguard is an index fund, so obviously they did like the index did 13.9% down. Philadelphia was a bit of a disappointment, and we will likely at the subsequent meeting come with a recommendation to consider replacing Philadelphia. They have had bigger swings than we would like, and we'll see what we can come up with as replacement. The other managers have actually held up quite well on a relative basis. Walter Scott, as you can see, outperformed by 4%, protecting on the downside, mainly because they have a lot of Japan in their portfolio, and Japan held up very well. IVAs also held up well. As you would expect, they hold both equity and a little bit of fixed income and some gold, and altogether they held up pretty well with that. As you can see, they outperformed their index by 7.2%. Aberdeen is probably the biggest success story in this portfolio so far. As you can see here, they have outperformed since we hired them by 8.3% annualized, which is very, very strong. And they've actually managed to outperform both in up and down markets, which is obviously something we really like. So they have been, the reason why they do it is that they focus on high quality companies that they have followed for a long time, that have solid balance sheets and have that they know and trust and can believe in. So they have avoided lots of the scandals that you've seen in Chinese companies, etc., despite playing obviously in that area. So that's very positive. DFA is a small cap oriented manager in a market that shuns risk. They will be hurt a little bit more, but actually it wasn't. I mean, 24% is obviously worse than, or 25% is worse than the 22.5% for the market, but it's actually reasonably for what they're doing. Archstone and Evanston, I will say disappointed. I think generally people were disappointed with hedge fund performance. It was a very hard period for hedge funds because the way the returns shaped out, especially in August and September, where August, you had decline until mid-August, then you had a very sharp increase until the end of August, and then in September you had a big decline again. And so some hedge funds unfortunately played the game of trying, they saw what was going on in August, they tried to reduce risk, then they saw the big increase and said, oh, we're gonna try to increase our exposure, and then just to be hit again by what happened in September. Mm-hmm. We don't like, and the fund of funds don't like managers that are playing these games, but unfortunately it happens, so they're reviewing their managers, not all of them, but those that they identify as having played those games. Other than that, there were some common grounds for stumbles among the hedge funds. There were some hedge funds that found financials to be very, very attractive because they were beaten down as much as they were, but as we know, they went down even further. They've also then recouped quite a lot, so we'll see how they do in October. But one of the funds, for instance, in Archstone, was a financially focused fund that does only that, and that was down more than 20% in the quarter. So again, they obviously did better than equities as we would expect them to do, but they were slightly disappointing. In terms of Wellington, the inflation hedging product also underperformed a little bit. They were hit by a couple of different things. They had a gold investment which became problematic in September, and had a focus also on some gold miners. They had in the agricultural space, they underperformed because they focused on some of the fertilizer producers rather than sort of generally food producers, and that also hurt them. Again, as you can see, since inception, they have held up their, if you will, their own benchmark, which is a fair benchmark. It's not just something they construct. So overall, we still think it's a good manager, but they did have a troublesome time here, and we're waiting to see how they're doing in October. Again, bonds were relatively hit here. The government credit index held up very well, as you know. The Treasury especially had a great quarter, and yields went down to an almost unprecedented level. I think they hit just below 1.7% for the 10-year Treasury yield, which I think few had thought that they would actually get there. Since then, they've rallied quite a lot, and they're up at about 2.2 right now. So they're really volatile. I mean, within the last year, they've moved from way above 3% down to 1.7, and now they're up again in 2.2. We still think that levels like 1.7% for a 10-year treasury, which is negative in real terms, is unsustainable in the long and even in the relatively short term. People are not content of sitting and actually losing money on a 10-year bond. But in a market where everybody's fleeing to safety, then that is still the safest asset out there, at least in the short run, and that's what people are focusing on in the panic situation. Again, we are thinking about, and part of the reason why we went into international bonds is obviously the fear of interest rates increases. We didn't go much more aggressive. We didn't go aggressively in there, and I think that's a positive. But we do need to think about further ways to diversify the bond holdings as well. Any comments to performance?
I just have one on the Philadelphia. You're considering perhaps replacing the Philadelphia. Have you thought of a timeline?
Sorry, a timeline for replacing? Again, I mean, it's not a blow-up situation. It's a solid firm.
So why?
It's a solid firm with a solid strategy, etc. But they just haven't, long-term performed as we had hoped they would. They've been in the portfolio for a long time, and so we think we should look at it probably at the next meeting, unless something else more urgent comes up.
The other thing about Philadelphia is that they don't manage currencies, so and we're going to be looking for a manager who does more actively hedge currencies in this environment where it's become very, very important to do so.
Okay. We have a proposal?
Yes.
for new-
Yeah, if you turn to the page called Manager Recommendation, a U.S. small and mid-cap manager recommendation, it's on page 15. So again, as I mentioned, we don't have currently U.S. small and mid-cap in the portfolio. We have a little bit of mid-cap through the manager, the index we have, but we don't really have small cap, and that has been a boon here in the last quarter. But eventually, we think that there are value in these areas when the valuation you go into is right. That's why we've identified this manager. It's an active manager called Boston Trust. Boston Trust is a company, obviously Boston-based. It used to be a trust company. It was bought out. The asset management part was bought out by its employees in 2004, and they have by now a very strong track record of managing both small and mid-cap portfolios. Now, what we're recommending is what they call SMID-cap, so basically a blend of small and mid-cap, and that is a strategy that is only recently gained traction, not just at Boston Trust, but in general, and you have seen a lot of small and mid-cap managers making these blend portfolios. That being said, for Boston Trust, it's a new strategy. They only had it for about 1 year, but we're comfortable with it because we can see what their mid-cap strategy did, and we can see what their small-cap strategy did, and we have included some material on that. And given that it's the same people that are managing them, that they have success with both of their products, we're comfortable recommending this despite a short track record. We've interviewed them and another manager. It was a good interview. What they focus on is quality, innovative companies, and they have a sort of an edge in trying to identify those. They've had good performance over time, and we think it's a very strong company, and we fully support the recommendation to hire this manager. Happy to go into detail with performance if you want to do that. We can do that on page 18. Where you can see that while this one has only been around for about the 9 month, little over, they have a year's performance worth. But you can see the performance here of 11.7 for the 9 months in 2011 exceeds the Russell 2500 index, which would be the SMID-cap index, if you will, a combination of the Russell 2000, which is small, and then including a mid-cap component. The other manager we looked at had a little bit better performance in the short term, but there were some worries about them, and especially the fact that they're coming off a 3-year track record. That is, they've had a phenomenal performance in 3 years, but before then had some stumbles, and we typically don't want to chase performance like that. So we think that this manager has a better sustainable track record and is the right time to hire him as well.
there a stated blend mix between the small and mid?
Yes.
And can you describe the ranges?
It's about 60/40, if you will, blend of small and mid cap, but they have the flexibility sort of to manage within so they can do 50/50 if they want to. They can basically go, and that's part of the reason why we recommend this mid cap. So if the small cap become expensive again, they can migrate to the larger end of the cap spectrum. So they have flexibility to move a little bit around the cap spectrum and not just necessarily stick to this precise blend of the Russell 2500. In terms of implementation, the recommendation is to be flexible, sort of in how to hire them. We recommend a 5% allocation, which is about $7 million. But think that if it suits the committee, to give CUNY staff freedom to implement within a 3 to 6% range. And also give a bit of flexibility with respect to timing. We didn't know whether there would be a big rally, and we've seen a big rally, so maybe holding off a little bit before we hire them, or hiring them maybe in 2 steps. So we start hiring them with a smaller amount, and then if evaluations improve, we go to the full amount.
Questions?
Why
don't you see what happens on Wednesday?
Right. My recommendation would be incremental, move into it incrementally.
Mm-hmm.
Okay. There's a resolution on the table.
Move it.
Okay. Second. All in favor?
Aye.
Any opposed? Motion carries. Okay.
We're done.
Okay. Thank you.
Well, a question for next meeting?
Sure.
Right. You look at the correlations between S&P 500 and World ex-US. They're running north of 90, and they have been for 3 years. Now, they may not stay that way, but if you make a globalization argument, maybe the commonalities in equity markets are growing higher than we thought. So the real question is, are we comfortable with 48% of our portfolio, basically, right now at least, in the same mix of stocks? I don't expect an answer now,
Sure.
but just a question to think about.
Research.
Right. We can focus at the next meeting on that
Certainly.
issue and the question on our overall mix. All right. Any other questions, comments? Enjoy. Thank you.
Thank you.
Thank you.
Okay, how you doing?